After 30 years without major changes, the Reserve Bank of Australia is undergoing its biggest overhaul since 1998.
The Reserve Bank is facing a major shake-up.
It comes in the face of strong criticism of the RBA and specifically Governor Philip Lowe for lifting interest rates 10 times.
It was 51 recommendations, quite a list there.
Treasurer Jim Chalmers ordered a review of the RBA last April. Now, in response to that review, the central bank is reforming the way it holds meetings, makes decisions, communicates, and carries out its operations. So, why should you care? What impact does this have on you? And for those of you with a mortgage, what impact does this have on the direction of interest rates? When times are good, we don't really notice the RBA, but with rising inflation and interest rates lately, it really matters how monetary policy decisions are being made and who's running the place.
Higher petrol prices leads to higher inflation, and higher inflation means higher interest rates. Economists say if inflation is still way too high, expect another rate rise.
I've spent the last few months researching the potential impact of these changes, not just on a bureaucratic level, but on an everyday level. And let me tell you right off the bat, you should care, especially if you have a mortgage. And in this video, I want to explain why. Let's start with some context. Why was the review necessary in the first place? The RBA is Australia's bank to the banks, otherwise known as the country's central bank. To meet its objectives of keeping inflation low and stable at 2 to 3% and all of us in jobs, the RBA sets the cash rate, which is the interest rate it charges Australian banks and ultimately the reference rate banks use to price your home loan. While Australia has enjoyed uninterrupted economic prosperity without a recession for over 20 years, many attributing this to a well-functioning Reserve Bank, some critics view the RBA's track record as patchy. Between 2016 and 2019, inflation actually undershot the 2 to 3% band, drawing criticism that the RBA could have done more to support the economy by cutting interest rates during this time. However, it wasn't until the COVID-19 pandemic and beyond that the RBA's activities really came into the spotlight.
The Governor of the Reserve Bank is once again under pressure to resign this morning.
An apology won't help you pay your mortgage, but there was one nonetheless today from the Reserve Bank Governor.
The country was in a dire situation, and the Reserve Bank, we wanted to do everything we could to help the country get through that.
To prop up the economy during an unprecedented health and economic crisis, the RBA slashed the cash rate to 0.1% and adopted unconventional monetary policies that overstimulated the economy. I won't go through these policies in detail in this video, but you can watch my fixed rate cliff video if you want to find out more. One of these initiatives was forward guidance, with then Governor Philip Lowe in 2021 advising the Australian public that interest rates would remain low for at least 3 years until 2024.
Our judgment is that we're unlikely to see wages growth consistent with the inflation target before 2024. This is the basis of our assessment that the cash rate is very likely to remain at its current level until at least 2024.
Although Dr. Lowe later advised that this was a conditional statement and not an expectation or a promise, many homebuyers took his word as golden, loading up on cheap debt and pushing Australian property prices to new heights. As we already know, the economic reality definitely played out differently, with inflation surging past 7% and the steepest rate hiking cycle in 30 years, and the cash rate going from 0.1% to 4.35% between April 2022 and November 2023. Embarrassingly, Dr. Lowe had to go back on his word, leading to a public apology and shredding the RBA's credibility and reputation as a shrewd economic manager in the process.
I'm sorry that people listened to what we'd said and acted on that and now find themselves in a position they don't want to be in, but at the time we thought it was the right thing to do, and I think looking back, we would have chosen different language.
It's against this backdrop that Treasurer Jim Chalmers caved in to public pressure in July 2022, announcing a wholesale review of the RBA. 10 months and over 100 submissions later, from Australia's leading economists, policymakers, and financial market wizards, 51 recommendations were released over 282 pages, summarizing vast amounts of critique and commentary. I spent weeks poring over the nuts and bolts of the recommendations, and I think there are 7 points you should care about, which fall broadly under 3 themes: clearer monetary framework, improved decision-making, and improved communication and accountability. On the day the RBA review was released, Treasurer Jim Chalmers announced that the Albanese government would accept all 51 recommendations and that he had unanimous support from the opposition. The changes were marketed as an RBA fit for the future, a revamped RBA, and the RBA 2.0. And, at face value, it seems that the advantages of the review are evident. A clearer mandate with better wording and less confusion. Alignment to international best practices, with more relevant expertise added to the board, and more access to RBA staff and resources. The change from 4 to 6 week cycles also gives the board more time to consider richer data and diverse perspectives, ultimately giving more time to discuss, deliberate, and debate a tough cash rate decision. More time between meetings may also be better for borrowers, giving you additional time to adjust to each interest rate change. And finally, each decision should also be explained more clearly, enhancing public awareness and ensuring greater transparency in monetary policy. And with the first board meeting of 2024 out of the way, I'd say it was a good trial run to see these advantages in action. The monetary policy statement seemed to be written in plainer English, while Governor Michelle Bullock seemed to be taking questions in her stride. We also saw the more human side of the governor, with expressions of empathy for mortgage holders and concerns for those on lower incomes.
And the best thing that we can do is help households deal with the cost of living by getting inflation down. We want it back in the background again when people aren't worrying about it.
But it's still early days and not everyone has been happy about the outcome of the review. The most vehement of critics of the RBA review was former Governor Ian Macfarlane, who argues that the recommendations are radical and that there was no opportunity for public debate after the review was released. In 2 publications for the Australian Financial Review and an interview on ABC's 7:30 report, Mr. Macfarlane made several criticisms, and I'll highlight these as potential disadvantages of the review. For example, Macfarlane challenges the review's approach to treating employment and inflation as equals, arguing for a singular focus on inflation to guide monetary policy. There are also some apprehensions about the composition of the board, specifically the shift towards entrusting monetary policy's voting power to predominantly external members. There's also a concern that it could be filled with academics. Another concern with the board is about the dynamics of power. With the majority of them being part-time external members, the worry is centered around the potential for the governor to be outvoted and challenges to the robustness of their leadership. The pacing of policy adjustments also comes under scrutiny. Critics argue that increasing the time between interest rate changes could make monetary policy less agile. And the push for more communication, while well-intentioned, might muddle the message if board members' views are too different. And lastly, accountability seems to be a particularly thorny issue. Without a specific individual like the governor signing off on monetary decisions, critics worry about a diffusion of responsibility. This could lead to situations where the governor must defend decisions she didn't support, blurring the lines of accountability. Even former Treasurer Peter Costello joined the chorus, saying a divergence away from the inflation target gives the RBA too much to focus on. AMP's chief economist Shane Oliver also argued the RBA's track record at managing inflation under the current board arrangements was better than other countries under existing frameworks that did not necessarily need to change. All in all, the naysayers argue the RBA reforms result in a risky experiment for Australia, of which the results are yet to be seen. So who is right, who is wrong? I'll share my view in a minute, but in the meantime, let's take a look at what the RBA review means for the direction of interest rates. I already mentioned this. Over the last 2 years, interest rates have gone up 4.25% and an unprecedented 13 times. As a mortgage broker, what we're seeing with our clients is that for every $500,000 in borrowing capacity, this means an increase in monthly repayments of roughly $1,200, from $2,250 to $3,450, or 53% increase, which is a massive crunch on their household budgets, especially when other costs are going up at the same time. So, will this trend change because of the RBA review? There are a few ways of thinking about this question, and I think a good way to frame it is to think about the direction of interest rates over the short term versus the long term, and consider what are the drivers of this decision. Well, I've got some good news and some bad news. In the short term, the good news is that the market expects interest rates to fall this year. Most economists believe that there will be 1 to 2 rate cuts over the back half of 2024, with interest rates declining by as much as 0.75%. And when this happens, we'll be looking at some refinancing options for our clients. But this has very little to do with the RBA review. This is because the twin mandates of targeting inflation and maintaining full employment are not new, and fighting inflation without breaking the economy is still the RBA's #1 priority. Governor Bullock made it very clear in her press conference that the RBA board has always thought long and hard about the impact on jobs every time it makes a cash rate decision. And this is what economists refer to as achieving a soft landing. At the time of recording this video, inflation was declining, but is still too high at 4.1% on the latest figures and outside of the RBA's target band. But this is counterbalanced by weaker consumption, weaker dwelling investment, and uncertainties in the global economy. Now, in the long term, the theme is higher for longer. We live in a very different time to the pre-pandemic world and the era of easy money. Going forward, the direction of long-term interest rates will inevitably be determined by the economic data emerging at the time. Assuming inflation is in check, which the RBA forecasts to do by 2026, the cash rate should settle back to a neutral rate of around 3 to 3.5% next year. This could have a meaningful impact on people's borrowing capacity and their next home. At this point, if you decide to leverage that, I've got a free guide to show you how to buy your next home. Links in the description below. Keep in mind though, that more global shocks and conflicts may lead to unexpected volatility in interest rates and the readoption of unconventional monetary policies like during the pandemic. But the newly constituted Monetary Policy Board should be better equipped to deal with these challenges, leading to a smoother profile of interest rates in the future compared to the steep rises we've experienced in recent times. If I were to round up my thoughts in all of this, I think the recommendations of the RBA review are good for monetary policy and good for the welfare of Australians. Respectfully, I don't agree with Ian McFarlane that the recommendations are radical, and borrowing from the words of John Kehoe at the AFR, the reforms are more evolutionary than revolutionary. Ultimately, there is little practical change to the RBA's current economic mandate. Pursuing the 2 to 3% inflation target while maintaining full employment has always been the goal. The establishment of a separate monetary policy board modernizes the RBA by bringing it in line with its global peers, giving board members more time to make better decisions. While the majority of external appointments is unconventional, the RBA has always had outsiders making up most of its board. And history has shown that this is likely to be a healthy mix of high caliber members who are not all academics. the RBA is also unlikely to repeat its pandemic mistakes. The increased communication is welcome, and the first press conference of 2024 has proved that. Whether there are doubts about the consistency of communication or accountability of the governor, this will depend on the nature of who is appointed and the cohesiveness of the board. But I'm confident that after listening to early speeches, that Governor Bullock is more than up to the task. And finally, mortgage holders can expect some rate relief towards the end of the year, although the future rate outlook is likely to be higher for longer. And that's it from me on unpacking the RBA review. I hope this gave you some clarity on what's happening at the moment. If you have any questions about the impact of this on your mortgage, or if you're looking into refinancing, feel free to reach out to me for some guidance. Otherwise, thank you for watching, and if you've learned something valuable from this video, please subscribe to SF Capital on YouTube and follow us on socials.